I'm a professor at London Business School. I've been at London Business School for 22 years or so, and I'm joined by two colleagues, Philip Kurtenbach, who's from HSBC. Do you want to just join me up on stage, and then I'll give you a chance to have your say, and Simon Binney. I think Simon is here. There you go. Perfect. So please take a seat. I'm going to ask the two panelists to share their thoughts. I mean, I will profess moderate knowledge of the world of robo-investing. We all know intuitively, I think, what robo-investing means. It's something to do with artificial intelligence helping us in our investment activities. But of course, artificial intelligence is a multi-faceted thing, and the ways in which it's going to be influencing investing for good or for bad is something which I want us to have a little bit of a discussion about. I've got some hopefully provocative questions. Please, as always, if you can put your questions up through the Umbrella app. I've got a little iPad here which will give me a feed of the questions that you put. I've got a few to start with, and then as we get through the session, I'll bring a few of your questions in as well. So let me ask first, actually, I'm going to ask Simon to speak first. Why don't you just introduce yourself, tell us a little bit about who you are, your company, Wealth Wizards, what you do, and then I'll ask Philip.
Okay, thank you. So Simon Binney, Business Development Director at Wealth Wizards. I've been with the organisation for just over 5 years and been in wealth technology for probably the last 25 years with HSBC, Standard Life, and a number of other startup organisations. Very focused on the kind of retirement savings and specifically the wealth management market and technology over the last 15, 20 years, and looking at how technology can help to really address the advice gap and the savings gap. And at Wealth Wizards, we're very much about making financial advice affordable and accessible to everyone. So we're looking at both ends of the spectrum, really. How do we help advice businesses to service and manage their high net worth clients more effectively and efficiently, so that maybe they can have more of them, but also hopefully so that they can free up capacity to be able to onboard some of the lower net worth clients and manage that issue about making financial advice affordable and accessible to the lower end, who hopefully are going to be the high net worth clients of tomorrow. And just to add to that, for those of you who weren't at my talk earlier, we're kind of a little bit unique because we have our own advice permissions. We're a regulated business, and we combine that full regulation with world-class engineering.
Perfect. And I'm going to come back to the engineering bit in a second, but Philip, why don't you introduce yourself first?
Hi, my name is Phil Kurtenbach. I'm part of HSBC. I'm Global Head of Wealth Structure Products, which doesn't necessarily mean robo-advising at all, but as part of my work with HSBC, I'm involved in trying to shape kind of the future vision and the future state of how we interact with our clients, that's where robo-advising potentially comes more into play. Been with the group for over 13 years, and then I've part of other financial organizations overall for just over 15, 16 years. So been through various different roles, but a lot of it around wealth management, from frontline over the risk aspects to, and now more of the product management side.
Got it. So look, let's dig into the thing underneath the product, as it were, because we've all got this sort of intuitive sense of artificial intelligence. I guess, Simon, I'm going to ask you about this first. For me, computers have been getting better, faster, smarter for the last 50 years, 60 years. We use the word artificial intelligence now, but essentially what we're talking about is computers just getting better at doing their job. They are figuring out through clever algorithms ways of doing things better. Just give us a sense of just how clever the technology is underlying these products, because from my slightly naive point of view, it's not that difficult to take a bunch of information about my risk profile, when am I going to retire, a few things like that, and to come up with some recommendations. How clever is the technology here?
Well, first of all, the technology is very, very clever.
Okay, good.
But I think it's really important to understand there's a few what I would call overused terminologies in our industry. One is robo-advice. Yeah. Because 99% of the people that purport to give robo-advice or have a label of robo-advisors don't give advice. Right. It's education and guidance at best, and that's not their fault. It's the label that's been put on them. I think AI is an overused term. Yep. Because yes, artificial intelligence does exist, and certainly we use an element of AI as well as machine learning, but it's used in a very specific way, which I'll come on to in a second. And I think the last thing is that we use a term that is underused, which is intelligent automation. Because I think we've seen the theme throughout the day today, and generally across the market, that everyone kind of speaks about, is that the hybrid model is the future. You need to have the advisor at the center of the client relationship. So how do we use that technology and all of those terms to make sure we're supporting the advisor to give the best possible advice? So where things like machine learning and AI come in is where we're using this very clever technology to look at past cases that have been given by advice firms to work out, has it been consistent? Have you got outliers? What you know, and your best advisor on their best day, what advice would they have been given? And let's try and develop the technology to be able to replicate that, but not limiting it to that. So we don't want to go to the kind of RoboCop extreme of the technology suddenly decides what it's going to do and change everything that we've thought about advice for years. There needs to be some parameters and a framework in that. But let's make sure that the technology is learning the way that the UK industry, if you like, or any other territory, gives advice, and then maybe come up with some suggestions about, have you thought about maybe doing it this way, that maybe we haven't.
Right. So the database on which the machine is learning, from which the machine is learning, this is not just past performance of a bunch of different assets. Are you saying it's also actually looking at advice given, advice taken, and trying to draw patterns out as to what sort of advice people are actually susceptible to? Is that?
So to a degree, yes. So, you know, the best predictor for the future is the past. Right. But our view as a technology developer and what we like to think is an innovator and a bit of a disruptor is that that's only one part of it. Because, and I used the analogy in my talk earlier about the IBM technology that kind of played Gary Kasparov at chess, and first of all lost, but it learned an awful lot from that experience. Right. And then it beat him, and he called it a cheat. But I think the most important learning from that is that the technology learned how to play the game, right, and then it learned how the human element can interact with that, and the technology came up with ways that maybe the human hadn't thought of. You don't have to accept those ways, and you have to have controls around it, but maybe we're too ingrained in the way we've given advice in the past, and maybe we do need to use some of this sophisticated technology to give us some suggestions for how it could be improved, or areas we hadn't thought about. Right. And I think that's the key with ML and AI.
Got it. Philip, I mean, you're client-facing. I mean, you're within HSBC, you're creating products which then your financial advisors are selling or whatever. Tell us how the market is responding. To tell us what your customers in all the different segments are saying when you say, how about a bit of robo-advice?
Yeah, firstly, I agree with you. The term robo-advice almost has a bad label now. And people hear about robo, they're like, oh, no, I don't want it. I don't trust it. So I think that the term is, I like your analogy, right? So firstly to the AI versus the intelligent automation. Right? It's like the beauty of AI is that it really can tell you things that you can't. And I've got an analogy of the cat pictures. I don't know whether you know this. So the two differences is like I can go to a machine and tell him 150,000 parameters that make a cat, a long tail and whiskers and whatnot. And then that machine can, faster than any human, identify cats by those parameters, depending on how many it gives. Real AI, and that is where the industry is still learning, is actually when I give him 100,000 pictures of cats and non-cats and just tell him this is a cat and this is not a cat. And the computer will learn ways how to identify a cat that we may have not thought about. So now you overlay that with where the advice industry is going. I can tell a machine saying, like, if a company has overperformed on its revenue targets, probably the stocks are going to go up, and it will learn and it can really do it fast. And the moment news are out, it can give you recommendations. The real beauty is that let it run over it and just saying, like, this is when a stock went up and down, and let it come to its own conclusions, where controls will become incredibly important. So this is maybe really far in the future. So where do clients see this today? It's a split. I think for me, like robo-advice or digital advice has got three blocks. You've got number one, the classic, I'm taking a risk profile or custom information and match it with some sort of strategic asset allocation. Number two is the fulfillment of this asset allocation, where right now what clients have been most receptive to is simple solutions, one fund or a small portfolio of funds. And we've seen FinTechs and banks adopt that very much. There's a question mark of how deep or how individual we can get about this. And the third part is about additional kind of like services that can be provided around, and like nutmeg or things like that, where you can skim your credit card to invest in things that a classic wealth manager will not do. So where's the industry today where the client's receptive to simple solutions? So the matching of a risk profile to a strategic asset allocation, we see growing numbers of demand in the industry. If you look at the growth in AUMs of robo-advisor or digital advice, it is growing. It's expected to grow at 20 to 30% over the next 5 years. We believe the statistic, and I guess that's still in its infancies as well, but that's expected to grow with an adoption rate at the moment. If you look at, I think in the US, it's 8% of people have used a robo-advisor. Over 25 additional percent are ready to do so or are interested in it. And then those additional services is probably something where people have been very receptive to. Innovative ways to invest, not necessarily the underlying product, but skimming your credit card, having every time I buy a product from Starbucks, put £2 or put an extra £2.50 or how much the coffee was. Those are the three elements where I think the industry is where we are right now. And I think the big parts of where it could go is, number one, on the depth of fulfillment. So moving away from just simple solutions, just a fund to will customers be ready, and can we model or build reliable single line equity or single line security portfolios? And in terms of the additional services, can we mirror more of a private banking individual advice journey, like what an advisor would do? This equity is now no longer buy rated. Do you want to switch, and automatically give you rebalancing ideas? I think this is an interesting kind of, those are 2-3 interesting elements to go to.
So in terms of right here and now, HSBC Wealth Management, most of your clients, all your clients, still have an advisor who is then, supplemented with some technology. Is that correct? I mean,
not quite. Not quite.
Go on. Just because it's so easy to kind of, look into the future and imagine a world that may or may not happen. I'm keen to just make sure we're clear what the current sort of status is.
So I think if we look at our client segment, so the mid-tier mass affluent customers all the way up to a private banking will have a relationship manager no matter what. Whether they then choose to invest in the markets where we even have launched some sort of robo-advice, that's irrelevant. They will still have an RM. The lower end segments, though, that do not have a wealth advisor, those ones, for them it's interesting because it's a service that they cannot actually access via HSBC right now or via many other banks. So I think that's where, no, they wouldn't have an RM necessarily. But do we have support staff to guide them through the journey, to help them if they have questions? Absolutely.
So let's say I'm in that category. I'm not sure I am or not. But you'd say to me, you can't afford a relationship manager, but would you like to use this service? And basically you're going to type in a bunch of information about yourself, and it's going to recommend me a particular portfolio. Yep. And then I can say, please go ahead and execute that, and just keep churning it as the market evolves. Is that right?
It's often they're often multi-asset funds in this. So that's where we're at, and a lot of the industry's at, is where you don't actively rebalance your portfolio. That's why you're in a multi-asset fund that actively does that for you, because it isn't from a cost to serve, but also from an individual client, that the need to have constant individual conversations is just not there. But in that instance, it would be, look, for you, we have a solution for you, which is the digital round. Yeah. And
then I just let it run basically until I update my risk profile. Exactly. And and perhaps you don't want to share numbers, but there's a big chunk of people who are already in that category. Are they mostly younger people? Or?
So is it a big chunk? No, because it's a fairly new. It's not in all of our markets. So we've got, I think, 3 markets that have launched this, and it's a growing segment. The early adopter often are younger ones that are just about to grow their wealth, new into working, they want to do something, so to start off with that. But again, I think we'll see a larger adoption of it as we roll it out and as we get more sophisticated and improve the offering that is available.
And so my mother, who's 86 years old or whatever, I mean, should I be advising her to stop paying these 2% management fees to her current advisor and to just do it this way?
So I don't think there's a blanket answer for this, to be honest. It depends.
I mean, I'm being a bit flippant, but my point is clearly that some people are not comfortable with
Absolutely.
with this. Simon, how do you think about this question about trying to roll out this product, which works? I mean, I think we can absolutely agree that the technology is now sufficiently sophisticated to do it, to overcome the barriers to adoption amongst wealthy people.
So, and again, I think there's a segmentation issue here, and we're seeing that from a number of different partners that are using the technology for, as I think the previous speaker said, there's different business drivers.
Yeah.
So we're seeing some advice businesses that are looking, and retail banks that are looking to attract a younger population that they can't afford to service through the traditional advice method face-to-face. So let's use onboarding, KYC, identification, analysis of customers coming on, give them the right sort of information, make those journeys very intuitive and compelling, like an Amazon journey. You know, I think I said earlier that, you know, if every time you try to order something from Amazon, someone phones you up, went, "Hi, what do you want? How much have you got? How much are you going to spend? Are you interested in this as well?" You'd be like, "Go away." You know, so it's understanding how do people want to access this information, but also that there's different business drivers. Some of the organisations we work with are starting what we call right to left, which is let's take our high net worth client part of the business that's on the more complex end of advice around retirement, consolidation, DB transfer, and let's make that process more efficient, take the heavy lifting out. So that's the intelligent automation. Keep the advisor at the forefront of the conversation, but take away all the admin that sits behind them so they can do it more efficiently and service more people. Yeah. Others are saying, right, okay, let's either that's fine at the moment or we'll get that under control in a minute, but I've got a problem because I've got an ageing population. So a lot of the building societies we work with are saying average age 78. We want the sort of 40, 45-year-olds who are going to be, you know, the next. So how do we onboard them? How do we engage with them? They want different things and they, you know, have different spending patterns. So let's use the digital onboarding. And I think we should never assume that just because someone onboards digitally, they'll stay as a digital client forever. That might be the way that we attract them in and use the kind of gamification and the very nice, intuitive journeys. But actually, it might transpire that either because they just want, I want to talk to someone now. And if you don't want to talk to me, then maybe you're not the right company to support me. Or that through an identification from the advice business or wealth business, it's like, you've got a £250,000 SIP, or you've got some complex IHT issues, we need to talk to you. But if we can onboard more people digitally until they need to be served by a person because of the expertise that person can bring and the soft facts and the knowledge, that's going to help us as an industry serve more people and get people more, if you like, on board with the fact that this isn't some big, mysterious, scary place. It can help you.
Got it. So if we look at let's say 5 years, because that's long enough, but 5 years into the future, technology continues to get better. We know that the technology, as I say, works sort of in a box, mostly, but not exclusively, intermediated by existing advisors. We're all now familiar with, you know, using Siri and Alexa or whatever for conversations, and we can discuss whether we think they're any good or not. Do we see a future of robo-advisory, to use that term, where the dialogue is with a computer? Or, I mean, is that one of the things that you're mapping out as a possible future?
So our view is very much it will be a hybrid model. The advisor and the advice business will be at the heart of everything that we do. However, even now, one of our partners that uses our at-retirement capabilities, 40% of people can go through a full at-retirement process without talking to anyone. That partner chooses to call them all at the end just in case to go, "Are you sure you're okay? Because you didn't talk to anyone all the way through this and that was fine."
Is this the equivalent of me going through a chat bot, getting service on my
multiple
computer or
choice
whatever?
answers, going through, you know, the understanding piece, going through affordability, going through, you know, all of your needs, your requirements, your goals, but without necessarily having to talk to someone. You could talk to someone, but you don't have to. So that happens already to a degree, because a lot of people are quite happy. I don't want to talk to anyone. I know what I want. I want to take my tax-free cash, or I want to retire. I don't want an annuity. I want drawdown. I know why. I'll go through all the questions that I have to answer, but I know exactly what I want to do. So that already happens.
So the sophisticated investor, the person with money to invest, as you say, doesn't really necessarily want a conversation about these things. Phil, how do you guys think about it the same way in terms of the
Yeah.
interaction with the software?
Yeah, pretty much. And I think you mentioned Siri or Alexa. Can it be? To be honest, that's just a voice at the end of it, right? If you have an engine and a UX, whether you read the question on the screen or it comes to you via chatbot or via an automated voice, that's just a gimmick on top, pretty much. The underlying engine and the capability of doing this all without somebody. I totally agree. I think it is about choice. So the variety and flexibility is key. So we definitely see the point is there's a valid case for each journey. So somebody not even wanting advice, just executing trades. If I really know what I want, there's a point of where I want to do everything digitally or part of it digitally, and there will be people or journeys, right, for really complex investments or alternatives or things like that. Private equity, how are you gonna? It's much harder to integrate. So there will be a valid case for each of these, but I think the key will be exactly to this, to ensure that each of these are drawn out completely. If I don't want to talk to somebody, I don't have to. But if I want to have the journey end to end via an advisor, I can do that as well, as long as obviously cost to serve, etc., makes sense, right? But I think that will be key. It has to be and interchangeable, meaning that if I start a journey on one channel, I do not want to repeat myself, and I think that will be absolutely key.
That's the best way of driving us insane.
Yeah.
So look, there's some great questions coming through. I'm going to pick up on this one because it's specifically to this question of segmentation. What's your view on serving the high net worth, ultra high net worth segment with robo-advisors? Go on.
I think that there is a case for this, and again, we have to put that in the caveat to a certain extent. So what I mentioned is right at the beginning is if we think of the fulfillment of the strategic asset allocation and then the additional services. So I do think that there is a case for having the strategic asset allocation directly linked to a model portfolio to start off with. That's for more complex investors, right? I can have a single line rather than a multi-asset fund or a portfolio of 4 or 5 funds. I could have single line equities and bonds and structured products in there. That is definitely something that I think is possible in the future. And as well in terms of the kind of the additional services that we provide, if we think of a private banking experience, what's the big difference from a normal retail investor to theirs? Number one is the sophistication of products. Number two is having single line in the first place, and then also the ongoing advisory piece. You have normally a portfolio of something between 5 and 10 barriers that in any given time, any of these barriers is breached, URM will call you, and that could be volatility, that could be recommendation of an individual product, that could be anything else. And I think that there is a case, again, with intelligent automation and AI, to have these triggered automatically. Why wouldn't it be possible that if our CIO office today says Apple has been downgraded from a buy to a sell, that you get an automated push notification through the HSBC app that tells you Apple has been downgraded to a buy, looking at your exposure, we believe potential replacement or rebalancing pieces could be Facebook, IBM, or whatever, and you just click a button and say like, yes, execute equal weight into all 3 or just one, and you go ahead and the trade is done. I think there is a case for this, but again, it's about the capability needs to be built and needs to be tested properly, but I do think that that's a path where a certain percentage of clients will go for.
Interesting. Question about, it's a slightly more technical question. How can a firm ensure they are feeding their technology with enough data so it reaches its potential? Guys, this is probably more to Simon. I mean, it's a good point, isn't it, that artificial intelligence is shall we say, only as good as the data that is provided to it. By definition, that's what it learns from. And so there's a question about getting enough data into it, and also this question about, is that data in some way, shall we say, biased towards certain types of audiences? That's always a question that comes up with artificial intelligence. Any thoughts on that question?
So there's two, and I can only talk from our experience, and this is from working in the last sort of 12 years as a business to do exactly that, analyse and take in massive amounts of data. And we take past cases, as I said earlier as well. One, because it's quite useful for the advice business to see, have we been consistently giving good advice, or have we been inconsistent? Have we got any outliers? But two, the key thing for most of these businesses we work with is, how does our advice policy align to other advice policies in the industry? So benchmarking is really key. So that's where you get the massive data where it's more important, because if you've got 1 million cases from one advisor, actually all that tells you is how consistent or good that advisor is. If you've got 10 million cases from 500 different advice businesses and a couple of thousand advisors, that's when it starts to become powerful, because not only can you see as a business how are we giving advice and how consistent are we, but also how do we match up against other businesses and can we learn anything from that? And the AI is learning from all of that to go, oh, this is interesting, so this advice firm does it like this because they've weighted something this way. This advice firm does it like this, or there's a bias towards this, and you're way out of that. And so you're talking at more an advice policy business level then, rather than an individual piece of advice. That's when it becomes powerful.
So here's a question I've been dying to ask, because everything you say I get, and I can see that it's necessary and that it's also going to lead to a convergence of advice around where the market, either as a whole or subsegments of the market, are going. And I dug out this quote from the Financial Times 5 years ago. When it comes to investing, human stupidity beats AI. And I just love that, because what they're saying, I mean, you can intuitively figure out what they're saying is, you know, the Warren Buffetts of this world won because they were contrarians. They had a point of view. They doggedly stuck to that point of view through thick and thin. They deliberately placed bets to, as it were, buy when everyone else was selling, and vice versa. And if your objective is to more or less follow the market or some subject of the market, then you can either buy an ETF or some sort of passive investment strategy. You can go to some sort of AI-based thing, and there's a good chance that AI will also do equivalently. So how, if at all, can we use artificial intelligence to replicate the Warren Buffett strategy and accept the fact that sometimes it's going to be completely wrong as well as completely right? Well, this is obviously something you've thought about.
A lot.
I would love to dig into this, because for me this is the heart of what makes AI kind of different.
So this is what our data scientists, whose average age is about 13, or that's what they look like anyway to me, this is what they spend their time looking at and analysing, which they're passionate about. And I can only speak about their view, which I guess is a company that we share, which is we can put as much past and current data in as we like. All it's going to tell us is how do we do it now.
Right, exactly.
The interesting thing is how could we do it?
Right.
So, and again, it comes back to that the IBM deep blue, deep thought analogy, which is what we need to teach, and this is what we're doing at the moment with our technology. So we've taught it the rules of the game, if you like, in terms of the way that we give advice now, and that includes all the regulations within the UK. So there's a framework in place to say there's certain things you can't do, even if you think it's a great idea. You can suggest them, but you can't really do it. What they're working on now, and have been for about the last 12, 18 months, is let's teach the technology what the end game is, as in the pure end game, which is maybe as much as possible with a high risk profile, or as safe as possible with a low risk profile. And that takes into account all past history of how investments and investment managers have performed and funds have performed, and all of that information, plus the way we're giving advice, so that the tech can come up and say, that's all very interesting, and that probably will get you to, you'll get these pension statements. You might have 10 quid, you might have 5 million, you might have somewhere in the middle. Okay, that's great. That tells me nothing, and it's incredibly safe, isn't it? It's starting, we're seeing now through the patterns the technology is coming up with, to be a lot more interesting in terms of, have you thought about looking at an investment strategy like this for that risk profile? You go, and our advice business looks at it and goes, no. Right. And that's where it's starting to get interesting, because it's understood not just the rules of the game, but what the end game is. And the end game is a simple thing, which is maybe as much as possible for a risk level 7 person. Right. There might be different levels of end game, but according to that end game, how would I, learning everything I've learned from all this massive data I've taken in, how would I get you there? And it might be very different to what...
Agreed, and I want your view on the second, but one more question to Simon. So the trouble is the technology doesn't get into the details of the companies. Let's say this is equities. It's not only equities, but if it's equities, what Warren Buffett will do is he will actually look at the management of the company, he will look at the activities of that company, he will look under the hood, as it were, and he will start to see things. The trouble is that you're not feeding them that information, or perhaps you are. I mean, you're saying maybe that is the way, is that the way of the future? Because obviously if you just feed it financial information, it can only give you, this stock is overvalued, against historical norms, right?
So in the same way that we originally developed the technology and we started at the more complex end around things like DB transfers and abridged advice we've developed now along with the FCA to say, right, okay, so there's maybe 15 factors that will determine whether you should or shouldn't transfer from DB to DC. Right. And different advice businesses and their policies will have a weighting, it's like a graphic equalizer in very simple terms. Yeah. They'll have a maybe slightly different weighting on some of those to determine whether you should or shouldn't transfer. Yeah. So in the same way that we've done that from a product perspective, what we're actually looking at now is saying, okay, so there's a number of different weightings that could determine which investment fund or investment manager or portfolio might do that, and maybe we need, and now we're understanding, and what are the things that impact that? Right. In the same way that Warren Buffett would go, I've got 20 things that I look at, and I've got a weighting on them, and if they tick those boxes, I'm going to invest in that business and I'm going to invest big. Yeah. The same applies. Basically, it's a rules-based system. You just need to teach it the rules and the end game.
No, indeed. I get it conceptually, and of course, the challenge is, what do you feed the data? What data do you feed in, and is it going to come up with some surprising insights? Philip, how do you think about this question about the client who comes to you and says, I don't want to just meet the market. I want to, either double my money or lose all my money or whatever.
That's an interesting. But yet, I think to echo what you said, it's I don't know whether it was Warren Buffett, but one of the big investors, he said like, when I was young and I learned the rules of the game, my mentor told me never invest in a company where the CEO wears a bow tie or has a mustache. And I can definitely vouch for the mustache. That's what he said. So it's one of them. So it's like, you're right. What is that something that anybody really looks at? He did, and he went well. So in terms of AI, I guess it is really just what data you can feed. You can feed AI you can feed them the full CVs, the looks, the clothing preference of each management of each person on the board. And the point is that the beauty with AI is that eventually you don't have to tell them whether a mustache is good or bad. Yeah. As long as you tell them whether you had a mustache or not, the AI will learn. And if there is a pattern, that's always the question. The question I think is more, is there a pattern to be found that we currently don't know? Yeah. Because if the answer to that is no, then the answer is no. AI will not beat the Warren Buffetts because he just saw something or had a gut feel, an intuition that he may not be able to put in a rule. Yeah. But if there is a pattern to be found, AI will find it as long as it has the data. Right. So, but is that something where I would today feel comfortable in going into? Probably not. But you know what? This is it. It's like the industry. Any industry has always been eventually dominated by a complete outlying idea. Yep. Steve Jobs came with a phone that has no buttons, and that's the norm. Right. And this is it. And I don't know whether there is something groundbreaking like that in banking, but AI is the best current known way of unlocking or finding that pattern. The danger is that AI doesn't necessarily tell you what that pattern is. Right. Yeah, yeah. Right.
No, I recall an academic study where they were interested in the ego of the chief executive as driving their investment choices, and they literally measured the size of the photo of the chief executive in the annual report as a measure of the individual's ego, and they found a statistical correlation.
There you go.
So literally, that's a bit facetious, I suspect, but nonetheless, I see exactly where we're heading. Let's take another question. This gets to the heart of things, I guess. Let me just go to it. The leading robo-advisors in the UK are yet to make a profit. What are the reasons? So let me generalize the question slightly, which is, okay, robo-advice is coming. Who actually wins from this? I mean, you've got essentially vendors creating clever technology. We've got companies like HSBC who are using that technology to help their customers. You've got customers, clients, who may or may not be getting better advice. Is it the state of the industry that we're investing ahead of additional profits down the road? Is that where we are?
100%. Well, and I think, again, it's very easy to put everyone under the same category of a robo-advisor, because you've got the pure robo-advisors that are just offering that and looking at gathering assets. And as I mentioned earlier in my talk, that it's kind of like £500. It's costing £500. You're going to have 20 billion to make it even viable. Right. But then you've got, we're not a robo-advisor, for example. We're a FinTech. We're developing groundbreaking, hopefully innovative technology that's going 5, 10, 15 years ahead. So the stuff that we did 5 years ago is profitable today. But we're investing loads more than that in what we need in a year's time, in 3 years' time, in 5 years' time. So the R&D costs are phenomenal because we're still in catch-up mode as an industry. We're so far behind using technology in our industry, everyone else, that the investment's got to be huge. So I don't think you should assume just because a lot of these firms aren't profitable that it means that it's a waste of time. Because actually it's about where we are in that cycle of development.
And does HSBC do invest in its own technology? Do you simply buy products from vendors like Simon's, or do you have your own team of people building?
It's both. So I think it really depends on we have an in-house IT digital department, etc., that works on new technologies and trying to innovate. But absolutely, there's pockets of pieces where it's just better to buy an expertise from elsewhere, white label parts of technology. I think to a certain degree, as a heart of investment business, because your own house view, your CIO team, your own strategic asset allocation is always key. So to a certain extent, we definitely need parts of us in there. But absolutely, like if we think of like the technology to skim your credit card investments, that's not something that you need to build yourself as a bank. So that maybe more something where you would look at. But definitely, it's both. You have to evaluate each of the capabilities that you need for a wholesome client experience. But to your question, who wins? In the first instance, I hope the customer. As with any industry where we saw new innovations, it's hopefully the customer that wins. More customers being able to get advice that couldn't, better, faster advice. So saving time is a great value in itself. And then in the longer run, I mean, Uber hasn't made a profit yet, or maybe they have now. But yeah. I now remember the conversations at the beginning of Facebook and saying like, yeah, that's a waste course because how are you ever going to make money with this? Like,
but presumably, I mean, I think of this in terms of the broader sweep of computerization across businesses in every sector. Inevitably, you need fewer people in HSBC. The more sophisticated that technology becomes. Now, is that right? I mean, that would be my
It's a question that always comes around, and it's like it's very difficult to answer because I think you mentioned it's like, say for example, various different scenarios. But if we build a digital advice and part of the journey is in a digital way, that doesn't necessarily mean we're going to cut down on advisors. Maybe the advisors can just touch more people and we'll grow our business, and we need the same. The second layer of this is who's building this technology, who's integrating it, who's designing it, who maintains it. That's maybe a different skill set, but it's still people. So do I think that there's more different job roles coming up and emphasis of certain job roles will change? I think so to a certain extent, but right now I just cannot see a world where we don't need a big advisor population to help our customers through this. And again, as we move up the client continuum to more sophisticated clients, with more sophisticated needs, and that's not necessarily more money, it's just a more complex needs base. It becomes harder and harder to fully rely on a purely digital servicing. So I think right now, again, maybe in 20 years' time I'll stand corrected, but right now I can't see a way where we.
I think we just to echo that from a sort of broader spectrum across all the partners we work with. Again, there's different business drivers. Yeah. Some businesses we're working with have scaled up so far on financial planners and specifically paraplanners and backup staff, admin staff, that actually they've got to the point where they said, this is crazy because it just doesn't work. It's not economically viable. No matter how much we scale the business, there's always got to be these 2, 3, 4, 5 heads per 1,000 new customers. Yeah. So it's not about replacing people, as you quite rightly said. It's about how can we use the same infrastructure we've got and costs to actually scale the business, but actually do it more consistently and compliantly as well.
Couple of questions taking me back to my mother's investment strategy, if you like. I mean, is there a trust issue with consumers giving their money to an AI to invest? Barriers to adoption, examples of winning approaches to get people to invest. Any additional thoughts on either almost like tactics for how do we overcome that trust question? I mean, perhaps this is more to you.
I think number one, it starts with educating, right? And then you need to educate customer of what it means, and I think then it's again side by side. You get some clients that just automatically adopt, right? It's like you get loads of people just who want to do it online, right? They say they would never want to speak to a financial advisor. That's an easier one, but for customers who are concerned, I think it is about, if you have an RM, or if an RM is there and they talk to their customers and they identify, it's not for us to drive customers or force them down a route, but again, for the advisor to have the best possible time. People do often have pockets of money, right? So with my pension, I almost want to do it and leave it, and there's other money where I want to grow aggressively. I've got a higher risk tolerance and things, and there may be then pockets within that where the RM then says, look, this is, if you want to, I'll walk you through it. Let's do it side by side the first time, and if you're uncomfortable, that's fine. And you take away the fear through that. But I think any form of forcing it too much won't work. And in the long run, it's the truth. So you will have the easy and early adopters, and people will then see. Then you'll have case studies. You'll have a proof of concept. You will have statistics where you can show, look, guys, actually, this is how our robo-advisor beat the markets 5 years straight. The reality will then, hopefully, if you've done a good job, then reality will help people overcome that trust issue.
Yeah, please.
Yeah, so again, from experience and feedback that we get from customers and their customers, there's two things. My favourite survey is, or survey question that comes back very consistently each year is, who's the organisation that you work with as a provider that pisses you off the most, that continually really annoys you?
Yeah.
My bank. Who would you trust most with all of your wealth? My bank. And so I think there's a lot of latitude there, which is really important, that it has to be a trusted brand. You know, HSBC is not going anywhere.
That's right.
You know, it's going to be there for the long term. Yeah, they're a big organisation. Yes, they might not always get it right for me, the customer, and I'm an HSBC customer, by the way, because when I work there, they insist you have an HSBC bank account. But actually, would I want to transfer to another bank? No, because actually 99% of the time they get it absolutely right. So I trust that brand. So if they're going to do something new, I'm going to go there first. And I think ultimately, as you quite rightly said, if over sort of 3 to 5 years my experience is really, really bad, or even in less time than that, if I'm less tolerant, I'll probably swap banks. Yeah. So we've got to get it right. Yeah. We've got to get it right. But actually, you've got a good chance to get it right because you've got that trusted brand.
They say that you're more likely to get divorced in this country than to change your bank.
Exactly.
I don't know if
that's a great stat.
It's completely true, but it's good. It's a good story. Yeah. No, there's for those who kind of dug back into the history of technology, there's a guy called John Nesbitt. He wrote the book called Megatrends 40 years ago. And he had this concept of high tech, high touch. And this is a concept he came up with 40 years ago. He said, any new technology has to be met with high touch. In other words, a human face, otherwise it will be rejected. And that was true in 1980, and it's no less true today. So I've got 2 minutes on the clock, and I've got one final question. How can we make sure our staff are using all the tools we've developed or deployed? I mean, it's one thing getting clients to adopt these things. It's quite another thing getting our relationship managers, some of whom have been doing the job for 50 years, to adopt them as well. Any final thoughts on this? And this is going to be the closing question.
So, yeah, I've got quite a few thoughts on that. Because we do get varying degrees of take-up and usage, if you like, across different advice businesses. The interesting thing is that in the first 3 to 6 months, you'll get the early adopters who are maybe a bit more tech savvy and not maybe been a financial advisor or planner for 30 years and no one can tell me how to do my job. But ultimately what it comes down to again is two things. One is productivity, which is driven by the business saying, how come you're only doing 2 cases a week now and this person or these other people that are using the technology are doing 8? And the second thing is, as a result of that, you're earning about 50% less than them as well, which tends to focus people's minds a little bit more that, actually, maybe I may not be an early adopter, but I need to adopt now. So it takes time, but people do adopt.
Yep. Your experience as well?
Echo it, yes, and I think in addition it is how do we incentivize our staff, right? It's education. One is education always. They need to actually understand and buy into that this is a good product for our customers, because at the end of the day we're all here yes, we want to earn money, and yes, we want to grow our brand and grow our assets under management, but this is only possible if we do right by the customer. So we need to build a product that actually helps the customers, make the staff see this and educate them around it. And then it is about, let's be honest, if I'm an advisor and I'm only incentivized by the cases that I write and not by the money that my client book brings in, am I always going to, I'm not being pushed to do what's right by the customer. So I think overall the staff adoption has to do with how do we treat our staff, and the staff outcome has to 100% for me align with the customer outcome. So as long as the staff does what's right for the customer, it has to be done. So things like I've just mentioned, and we've had that, I think we've seen that in the industry when apps first came out with retail products, where staff were concerned of letting customers know they can apply for a credit card online, because if they don't do it in the branch and they have their marker on it, they may not get the credit for this. And I think that and it has disappeared mainly with NPS scores and stuff like that. So again, the alignment of staff and customer outcomes will help drive that. So as long as you've got the right product for the customer, the staff will do the right thing for the customer.
And again, we come same survey every year to all the advisors we work with. What do you love doing? Talking to people. What do you hate doing? Writing reports and administration. This is made for you. Because the point is, we're not trying to replace you. We're trying to let you do what you do best. The soft facts that the intelligent automation can't do. What are your hopes? What are your dreams?
It's quite a straightforward sell, I do take the point. We are out of time, and apologies, there's a couple of questions we did not get to. But hopefully you enjoyed that. Please join me in thanking Philip and Simon. Thanks.